What is yield farming in decentralized finance, DeFi? A detailed guide to yield farming in decentralized finance, DeFi. What is yield farming in decentralized finance, DeFi? If you love making money, you would love using yield farming because it is considered a way to make more crypto with your crypto. The process includes lending your funds to others through smart contracts, and in return, you can earn the fees in the form of crypto. It looks simple. If that's what you think, then maybe you are going too fast. Although yield farming seems easy, the strategies for the same are considered the most complicated. The yield farmers move their cryptocurrencies across the various lending marketplaces in order to maximize their returns. Sometimes, these yield farmers are also secretive about the strategies because the more the people would know about a strategy, the less effective it would be. Yield farming is a field where farmers are up against each other in order to farm the best crops. Introduction. The movement of decentralized finance, DeFi, turned out to be one of the most innovative steps in the world of blockchain. The DeFi applications are unique as they don't require permissions, which means that anyone with internet access and a supported wallet would be allowed to interact with them. Additionally, they don't even require trust in the custodians or the middlemen. In simple words, they don't have to trust. Meanwhile, yield farming has emerged as one of the new concepts, a new innovative way to earn rewards by holding the cryptocurrency, and you don't even require permission for liquidity protocols. With this, anyone can make passive income with the help of a decentralized ecosystem of money Legos based on Ethereum. Before we move further to understand how yield farming works and what is collateralization in a decentralized finance ecosystem, let's try to understand what yield farming is. What is yield farming in decentralized finance, DeFi? Yield farming, prominently known as liquidity mining, is an innovative way to create rewards holding cryptocurrency. It can also be explained as a process of locking up cryptocurrencies and earning rewards. Somehow, yield farming seems similar to staking. However, there is a lot of complexity in the background. In several cases, yield farming works with the users, also known as liquidity providers, LP, that funds liquidity pools. What is a liquidity pool? Well, the liquidity pool is basically a smart contract that includes funds. In order to provide liquidity to the pool, the liquidity providers earn rewards that can be either generated by the underlying decentralized finance platform or the other source. Notably, there are several liquidity pools that pay rewards in various tokens that may be deposited to other liquidity pools in order to get their rewards there, and the process goes on. It seems complicated, right? That's why we said in the first paragraph that it was too soon to consider it easy. You see, earning money is always hard while grabbing your money is not that difficult. The basic process is that a liquidity provider deposits the funds into a liquidity pool and, in return, earns a reward. Basically, the yield farming is done with the help of Ethereum network-based ERC-20 tokens, while the rewards are also a type of ERC-20 token. However, several experts believe that this may be changed in the future as most of the process is done on the Ethereum ecosystem, while the cross-chain bridges and other advancements may allow the decentralized finance applications to turn into the blockchain agnostic. With this, they would be able to run on other blockchains that also support the potential of smart contracts. One of the most common ways to start a decentralized blockchain is to distribute these tokens according to the algorithm, along with the incentives related to liquidity. Thus, the liquidity providers are attracted to farm the new token and provide liquidity to the protocol. What is total value locked, TVL? A lot of people wonder what's a good way to calculate the overall health of decentralized finance, DeFi, yield farming. Experts believe the total value is locked, TVL. It is a process that calculates the volume of crypto locked in the DeFi lending and other types of marketplaces. It also is one of the useful indices to calculate the cumulative health of the decentralized finance and the yield farming market. It also compares the market share of various DeFi protocols. How does yield farming work? Yield farming is one of the prominent methods, which is known as the automated market maker, AMM. It usually includes liquidity providers, LPs, and liquidity pools. In yield farming, the liquidity providers deposit their funds into a liquidity pool, which strengthens a marketplace where the users are allowed to lend, borrow, or exchange the tokens. The usage of these platforms collects charges, which are paid out to the liquidity providers as per their share of the liquidity pool. This is how an automated market maker works. Apart from the fees, another incentive can be the distribution of the new token, which is given upon adding funds to a liquidity pool. The rules of the distribution depend on the implementation of the protocol, while the liquidity providers get a return on the basis of the amount of liquidity that is being provided to the pool. What is collateralization in decentralized finance, DeFi? In case you are planning to borrow an asset, you have to put up the security in order to cover your loan. In easy words, it works like insurance for your loan. Now, you must be thinking about its relevance. Well, it depends on how you are supplying your funds. However, you have to ignore the collateralization ratio. Likewise, if the collateral's value has fallen below the approach required by the protocol, then your collateral might get liquidated on the open market. Therefore, in order to avoid liquidation, you would have to add more collateral. In order to emphasize, each platform has its own set of rules for this, including its own required ratio for collateralization. Additionally, these work with a concept known as over-collateralization, which means the borrowers have to deposit more value than the asset they want to borrow. This way, the risk of violent market crashes liquidating a huge amount of collateral in the system is eliminated. So, if the lending protocol that you're using demands a collateralization ratio of 200%, this means that for each $100 of value you put in, you would be allowed to borrow $50. However, the experts believe that it's quite safe to add more collateral than required in order to eliminate the liquidation risk.